Have you ever wondered how auditors decide what really matters in an audit? Why we zoom in on some numbers and not others? And why one tiny misstatement could change everything, while another one doesn't even move the needle? Well, today we're breaking down one of the most important concepts in the entire audit planning process, materiality. And before we dive in, don't forget to hit like, subscribe, and turn on the notification bell so you never miss one of our accounting deep dives here on Canada Accounting Insights. All right, so let's begin with the basics. Materiality is part of the RAMP technique: risk, approach, materiality, and procedures. It's the M that guides how we plan, perform, and conclude the audit. Materiality is all about what matters to users of the financial statements. If an amount is big enough or important enough to change their decisions, then that amount is material. A misstatement is material if it could reasonably influence a lender, investor, regulator, or any other significant user. And this concept applies through every stage of the audit. Planning helps us decide what to focus on. Execution helps us assess errors found. Conclusion helps us decide whether uncorrected errors impact the audit opinion. So before we can calculate materiality, we need to fully understand who the users are and what they care about most. To make this concrete, let's bring in our first example. We're auditing FitFlex Studios, a rapidly growing fitness brand with 3 locations. The owner, Sam Rivers, has big plans to expand across Canada. FitFlex also took out a 5-year loan from the bank, and a potential investor, Skyline Investments, is reviewing year 1 financials to decide whether to invest. So in this case, our key users are Sam Rivers, the owner, the bank, the lender, Skyline Investments, the potential investor. Each one relies on the financial statements for different decisions. And that leads us into the next step. Now we dig deeper. For each user, what are they trying to evaluate? Here's how we break it down for FitFlex Studios. Sam Rivers, owner, wants to assess profitability and performance. Basically, is the business making money? Bank, lender, wants to know whether FitFlex can repay the loan. They also look at covenants and asset values because the loan is secured by property, plant, and equipment. Skyline Investments, potential investor, wants to know if FitFlex is profitable now and will continue to be profitable in the future. Once we understand user objectives, we can choose the right benchmark. Materiality isn't one size fits all. The benchmark must align with what users care about. For most for-profit companies, the starting point is normalized profit before tax. But depending on the situation, we might also use total assets, total revenue, total expenses, total equity. For FitFlex Studios, here's what we know. They've generated consistent profit. The bank monitors their current ratio. PP&E is being used as collateral. Investors care about profitability. Putting this together, profit before tax is the best benchmark, as it reflects what matters to most users. Now that we've chosen the benchmark, we determine the percentage. Typical guidelines are 3 to 7% of normalized profit before tax, 1 to 3% of revenue, assets, or expenses, 3 to 5% of equity. For FitFlex Studios, we want a lower percentage because the bank is new. Skyline Investments is a new potential investor. They will be highly sensitive to misstatement. So we go with 4% of normalized profit before tax. Now let's apply the numbers. FitFlex has profit before tax, $1,800,500. A one-time advertising campaign costing $250,000. Because that ad campaign won't recur, we normalize profit by adding it back. $1,800,500 plus $250,000 equals $2,050,500 normalized profit. Now apply our percentage. 4% times $2,050,500 equals $82,020. Rounded down, $82,000 overall materiality. This becomes our main threshold for evaluating misstatements, because now we talk about the concept that shapes the audit approach. Performance materiality is all about the safety cushion. Even if each individual misstatement is small, together they might exceed overall materiality. To prevent that, PM is typically set at 60 to 75% of overall materiality, which is equivalent to a 25 to 40% reduction. In the FitFlex case, the RMM is high, so we choose the higher reduction. 40% reduction, use 60% of overall materiality. So PM is $82,000 times 60% equals $49,200, rounded to $49,000. This guides sample sizes and testing depth. Specific materiality is only used when a certain account is especially sensitive to users. For FitFlex, the loan covenant and collateral depend heavily on property, plant, and equipment. The bank cares deeply about this balance, so SM makes sense here. PP&E, $7,430,000. We apply 1%. 1% times $7,430,000 equals $74,300, rounded to $74,000. This is lower than overall materiality, which is exactly what we want. Once SM exists, we also need to set SPM. Because SM was set, we calculate SPM. Using the same logic as PM, risk is high, so we use 60% again. SPM equals $74,000 times 60% equals $44,400, rounded to $44,000. This drives testing specifically for PP&E. Before we go into our last case example, it's important to clarify something students often mix up. Risk does not determine overall materiality. Risk affects PM and SPM. User objectives determine the benchmark and percentage. Materiality equals user-focused. Risk equals audit strategy focused. Now let's solidify everything with the full case example. Our second example is Bright Labs Pharma, a drug development company preparing to go public. Here's the user group: Adam Turner and Evan Turner, private investors, the bank, lender with PP&E as collateral, future public investors who care about profitability and long-term success. Now watch how each materiality step gets applied. Step 3, benchmark. Bright Labs is in losses, so profit before tax is not appropriate. Users are highly sensitive to asset values because PP&E is collateral. Development costs are capitalized. Investors and lenders care about total asset value, so we use total assets, $5,508,000. Step 4, percentage. Range, 1 to 3%. Because users are very sensitive, we select 1%. Step 5, overall materiality. No unusual items this year, so we simply apply 1% times $5,508,000 equals $55,080, rounded to $55,000. Step 6, PM performance materiality. New client plus first-year audit plus complex estimates equals high RMM. So we use 60%, $55,000 times 60% equals $33,000 performance materiality. Step 7, SM, specific materiality. Bank is highly sensitive to PP&E. PP&E equals $1,800,000. Use 1%. $1,800,000 times 1% equals $18,000 SM. Step 8, SPM, specific performance materiality. Again, risk is high. Use 60%. $18,000 times 60% equals $10,800. Rounded to $10,000 SPM. Before we close the video, here's what I want you to remember. Materiality is all about the users and what will influence their decisions. Follow the 8-step framework to calculate materiality. Normalize your benchmark when needed. PM and SPM are risk sensitive, but overall, materiality is not. SM is used only when a specific user cares deeply about a specific account. Rounding down keeps materiality practical. If today's walkthrough helped clarify materiality for you, especially the difference between overall materiality, performance materiality, and specific thresholds, don't forget to like, subscribe, and share this video with a fellow CPA student or colleague. See you in the next one!